Get ready, everyone. The housing market in the Lone Star State is heading for a major crisis in 2023. What used to be a massive Texan dream is now on the brink of becoming a nightmare, as soaring prices, reckless speculation, and troubling signs all converge to spell out a single ominous word: crash. It appears that Texas, a state once celebrated for its unwavering commitment to the American dream, is on the verge of a complete breakdown, leaving those trapped within the housing market bubble uncertain about their next steps. So, what is causing this impending storm that threatens to shatter the Texas market? And what will become of one of America's most robust and esteemed housing markets? 2023 seems to be bearing down on the state harder than others, with home prices skyrocketing and causing buyers to leave the market. The result could be a downturn that can leave a lot of homeowners wincing in pain, and the consistent talk of a housing bubble is causing a lot of worry in the market. Over the past year, experts have been focusing on Austin, reporting it as the central point of concern for the next real estate market crash. We'll use some interesting data points to help navigate through this theory. But before we continue, please click the like and subscribe buttons, as it will help the algorithm push our videos to the masses. Hit that bell icon too, so you're notified when we release new content. Bill McBride of the Calculate Risk blog wrote that inventory tells the tale, and in every housing downturn, it's typically preceded by a massive spike in inventory levels. In Austin, inventory levels rose 142% since 2021 and has exceeded pre-levels, which can explain why we've seen a 7-point correction from Q2 of 22 to Q4. Now, even though prices seem to normalize through half of 2023, there is definitely more data that we can point to help us understand. For instance, according to Redfin, the median sale price in Austin is now $559,000. The U.S. national average for a 30-year mortgage is now at 7.18%. So, assuming we were to put down only 5%, the estimated mortgage payment would be $3,590. The median income in Austin, according to recent Census Bureau data, is $78,000, or $6,500 a month. That equates to a mortgage debt-to-income ratio of 55%. So, values would have to see a significant decrease for folks to have the ability to afford a home in this city. This plays into demand. But that's not it. Let's stick with the concept of demand. According to more Redfin data, homes are on the market now for an average of 54 days. That's roughly 53% more than the beginning of 2022. And some experts say that's a harbinger of trouble, and that the lack of demand could lead investors and individual sellers to start lowering prices drastically to move inventory. We mentioned briefly, mortgage rates wield a powerful influence over the housing market in several ways. Firstly, lower mortgage rates make home ownership more affordable, attracting more buyers into the market. As demand surges, it can drive up home prices. Secondly, these rates boost buyers' purchasing power, enabling them to qualify for larger mortgages with the same monthly payment. This increased buying potential often results in buyers being willing to pay more for homes, which contributes to higher prices. Thirdly, mortgage rate fluctuations affect overall market activity. When rates are low, more people tend to buy homes, intensifying competition and elevating prices. Conversely, rising rates can deter some potential buyers, reducing demand and potentially leading to a downward price pressure. Mortgage rates are a critical factor in shaping the dynamics of the real estate market. With that said, the 10-year U.S. Treasury note is a crucial benchmark for interest rates, including mortgage rates. It represents a government bond with a maturity period of a decade. Investors consider it a safe investment, and its yield reflects market sentiment. When demand for these notes rises, their yields fall, influencing lower mortgage rates. Conversely, increased demand for riskier assets or higher inflation expectations can lead to higher Treasury yields, which in turn result in elevated mortgage rates. Thus, the 10-year Treasury note serves as a key indicator for the cost of borrowing in the United States, impacting both housing affordability and the broader financial markets. And with that said, as of September, the 10-year Treasury yield is 4.25%. Experts across the country are all warning of an impending crash, but it's logical to presume that it may start here in the Lone Star State. All across the state, inventory levels are beginning to see sharp increases. For instance, in Killeen, inventory levels have jumped 42% since 2022. Also, San Antonio has seen a steep increase of 18% in available inventory. A real estate editor and writer named Lance Lampert suggested that the data shows that of the 200 largest cities in America, 7 are now at the same inventory levels before the pandemic, and 5 of them are in Texas. Now, experts believe that there are other economic factors that could cause the impending Texas housing market crash. For instance, unemployment. Texas has recorded 16,000 job losses as of August, a reduced spending rate, and a fall in its financial stability. Are those job losses a trend? Only time will tell. But what we know is that an overvalued housing market, an increase in mortgage rates, and an increase in unemployment can all lead to an unfavorable situation. Some economics suggest that Texas could experience a gradual recovery by the end of 2023 due to unintended consequences of economic instability impacting the housing market, and that there are some signs of improvement. Decreased consumer spending has led to mortgage payment difficulties and increased foreclosures. Home sales sharply declined at the end of 2022, but rebounded by mid this year, with Texas home prices generally holding steady, except for Austin, which continues to struggle. And this brings us to speculation. A lot of real estate experts assume that speculative frenzy is one of the factors causing the Texas market crash. The prolonged speculative frenzy gripping the Texas market and holding on to it is causing property values to go up. This is due to the sudden rush by investors to purchase a home before the market changes. Lots of investors flood the market, causing demand to overcome supply and, of course, driving prices up. This is way beyond a level that is sustainable, and per the laws of economics, since the market cannot hold on to those highly inflated values of houses on the market, the crash is looking more and more inevitable. The Texas housing market crash is a perfect example of how speculation can change a market climate and cause great financial loss to the investors. There are many reasons for this crash, but the most prominent ones seem to be the triggering effects of housing speculation. According to Michael Sockets, without speculation, the size of a market burst would be 3 times smaller than it would be with speculation. This means that speculation distorts housing prices and influences other aspects of the market. Experts say that what is happening in Austin is just a price correction that will follow with a booming market in coming years. Other experts see these events as a direct result of how unaffordable homes have become. Others claim that the current events are nothing like the housing market crash of 2008, because both homeowners and lenders are in a much better position than they were back then. According to Lance Lambert, the Austin, Texas housing market is the most interesting housing market, and during the 2000 housing crash, it took Austin 43 months to fall 8.5 peak to trough. But this time, Austin is falling 10.02% in only 9 months. As you can see, speculation and mortgage rates seem to be fueling the housing bubble. And together with the sudden drop in price, things seem to be at their very worst in Texas. The average median home price in Texas is $349,600, down by 3.5%. And experts expect it to drop even further by 4% before the year 2023 is over. Home sales are also low at 16.2%, and the average rent is $1,444. Some argue that experts are exaggerating the situation, including Charles Haimsath, a Central Texas housing market analyst. He believes declining sales, rising inventory, and falling prices signal market rebalancing, bringing buyers and sellers closer to equilibrium. Ashley Jackson, president of the Austin Board of Realtors, shares this sentiment, noting that there is substantial market activity, albeit not at record-setting levels, in line with broader economic trends. Are we really witnessing a Texas housing market crash? Is it really helping to balance the housing market economy for buyers and sellers to be on the same footing while negotiating? Leave us your comments on your thoughts on the Texas housing market crash. Don't forget to like, subscribe, and click your notification button. Thanks for watching, and I'll see you in the next video.